Welcome to Something More with Chris Boyd. Chris Boyd is a certified financial planner practitioner and senior vice president financial advisor at Wealth Enhancement Group, one of the nation's largest registered investment advisors. We call it Something More because we'd like to talk not only about those important dollar and cents issues, but also the quality of life issues that make the money matters matter. Here he is, your fulfillment facilitator, your partner in prosperity, advising clients on Cape Cod and across the country. Here's your host, J. Christopher Boyd.
Welcome, everybody, to another episode of Something More with Chris Boyd. I'm here with our team members. I've got Jeff Perry, our co-host, pretty much every week here. I've got Russ Ball and Brian Regan, all of us of the AMR team at Wealth Enhancement Group. And Brian is our senior portfolio manager, and a good one for us to talk to this week as we're thinking about volatile markets. The markets have caught everyone's attention again, as we've had really following two very good years with market movements, a little bit of volatility re-entering the scene. We haven't had much in the way of dust-ups when it comes to the market. And with the onset of tariffs being on the minds of investors, we've seen markets get a little dicey. And that's not to say that there haven't been some ups and downs, some ups as well as the downs, but we've seen a decline from where we were earlier in the year. And I don't know, I'm sure all of you are feeling the same way, but we're hearing clients reach out a little more regularly with some concerns and some questions. How should we be responding to this? Is this something we're worried about? How are we dealing with it? So we thought this show would be a good opportunity to talk a little bit about our views as it relates to, first, on what's happening, and two, how we're responding to that when it comes to our portfolios, or how we have been positioning for it previously, and then a little bit of what may come out of that. So Jeff, what do you think? Did I cover everything on as far as the setup there?
I think you did. I think the key word that I'm hearing from clients past couple of weeks is uncertainty, right?
Yeah.
What's going to happen? How does this affect me? Should we do something? Should we get in? Should we get out? On both sides of that equation, just that uncertainty that people are feeling right now because of geopolitical events, political events that are on the front page of the newspapers or the first story off the news, and makes people nervous. And I'm glad we had Brian on to get his perspective on how he views all this.
Well, Brian, that's probably a good in for you to chime in. I mean, I think when we talked about this, the first thing you wanted our team to know and to be able to communicate with our clientele is, just because markets are down doesn't mean clients' accounts are necessarily down for the year at this point. What do you want to focus on first, Brian?
Yeah, it's interesting, right? When you say markets, what you really mean is like the S&P 500, right, Chris?
Yeah, I think that's what people are focused on. You're right.
Yeah, but when I hear the word markets, I think of all the possible investments you could make, and there are markets that are doing well here in the beginning of 2025, and I think that's
which are some of those, for example. Do you mind elaborating?
Yeah, I mean, most notably, the fixed income market's doing really well here to start the year, right? And most of our clients have a combination of stocks and bonds. So the first thing that I wanted to point out is that when I wrote an email to you the other day, that let's let clients know that despite the tariffs and the drawdown that we've had recently, that the portfolio is probably in the black still for the year, despite all that. So, this is a win for diversification when it comes to fixed income and individual stocks.
That's worth elaborating on just for a minute, if you don't mind. Last year, it seemed that it was a different kind of story than in what we're having this year. The more focused on the S&P 500, the large cap, growthier names seem to be better. You did that Magnificent Seven or whatever, and then this year, we're getting a little bit of a different story.
Yeah, that's right. I mean, fixed income did well last year too. So let's just say that that we are changing gears here. I think you want to dissect the stock market, right? The individual sectors of the stock market, and I think you're absolutely correct, right? So the more indexed you were to the quote unquote Magnificent Seven, the better you probably did. And that's true, over the last couple of years. But here in 2025, diversification in the stock market, not just having bonds in your portfolio, but within the stock market has helped out as well. We allocate towards a low volatility portfolio, which has done well in the black so far this year. International markets have done exceptionally well, including Europe and China. We don't really allocate towards China, but it has had notable performance here in 2025, and we have benefited from having an allocation towards the Eurozone, which has done very well, especially now that Germany's moving off their austerity position. Finally, we've had utilities in the portfolio for about a year now, and my view might have been unpopular at the time. It seems like people are kind of coming around to my way of thinking, but the idea was we're going to get more growth out of this sector than we have historically, and for a variety of reasons, from data centers to onshoring, to population growth. But at the same time, it's a regulated market, which should give us some support if things fall on the downside, and that's been the case. We've had nice performance from utilities as well. So, this is again a one in the win column for diversification. We've preached it, and we're certainly benefiting from it here in 2025.
Yeah, that's a good point. Jeff, you want to add anything to that?
I appreciate and agree with everything Brian said. I do have maybe a question that investors or clients might be thinking about. Does any of the moves, the political moves, the tariffs specifically, I guess is what we're focusing on here, have you consider any of the holdings, moving them in or out, more or less based upon the action and the tariffs specifically?
I'm trying hard not to have any knee-jerk reactions because I actually think it's a complicated subject. Believe it or not, I know that the opinions come fast, and when you have a complicated subject, what I find is the best thing to do is to do nothing, contemplate what's gonna benefit, what's going to be hurt, what's at risk, and be careful with how you move the portfolio. And that's part of the reason why we make decisions quarterly. It's to not overreact. We don't want to make harsh reactions to one data point. What we saw in 2019 was that the tariff news changed regularly, right? You'd have a big announcement that $300 billion worth of goods from China is going to be tariffed, and then the market would sell off 10%, and then 3 weeks later there would be some reversal, and then the market would rally 15%. So we want to be cognizant of that possibility, and not overreact. No,
and that might be a lesson for investors to recognize that it's very likely we're going to have some of that same kind of movements for up and down.
I don't know for sure, but that's what happened the last time we went through this with the same president, right? So it seems like they're most likely based on that historical experience. Chris sent me a note yesterday afternoon, and he was asking me if his comment was accurate, and basically it had two contrasting statements in it, which I think was what he was struggling with, right? In the first part of the note, he was saying, this might be a detriment to growth, and we might see the Fed react by cutting rates. And then in the last sentence, he said, on the flip side of that, we might have inflationary pressures, and the Fed might have to react in the other direction.
Yeah.
And the truth is, he was absolutely right. I mean, both those things are, even though they're contrasting, I think are both possible. And when you look at inflation expectations in the near term and the longer term, they're at odds too, right? In the near term, inflation expectations ratcheted up. In the longer term, they actually went down. So what is the market telling us? Well, in the short term, they think this is going to be, increase inflation. I wasn't sure whether I should say, be positive or a negative, because the number is expected to rise. And in the longer term, growth is expected to suffer from this. So, tariffs are bad policy generally, and this is why, right? We're going to get inflation and negative growth from this, which is also why I don't necessarily think it will last. So, that's the position
Maybe
we're in.
a quick. I mean, this seems like it's a moving target, but maybe we can just do a quick review of what has been implemented, what is anticipated in the next month in terms of. It seems like there's a fair amount of tariffs that have been announced and anticipated, but as we saw just in the last few days, there's been like, oh well, we're going to have auto manufacturers, but we'll hold off on that. Some of this can change and it is fluid, but what are we seeing? How much is this tariff change? What are the amounts? And then how impactful is that on what that means to maybe GDP or the growth of the economy?
I guess we should
Maybe
tell
start off with
listeners.
what's a tariff, huh? Is that
I guess
right?
well, no, I was going to say maybe we should tell listeners it's 11 o'clock on March 6th.
Yeah. Okay. Because it may be very different a day or two from now, and this is out there. Yeah.
A day or two. It could be different this afternoon.
Right. So
it's unbelievable that how right you are.
A tariff, just to review, is essentially an added tax on goods being brought into the country, so that it makes those tariffs more costly, those goods more costly, and therefore less appealing relative to the thought is to a domestically produced product, trying to inflate the appeal of producing goods and services in the United States versus brought here from other parts of the world.
Which is a reason, one of the reasons to do tariffs, right? Is you're trying to bolster your domestic production of a given product.
That's the stated objective, I think.
One of them, or to punish the sender. Right?
There's also the issue that it is usually met with reciprocal response. So then our goods become harder to sell in other parts of the world. It also does to the point about another reason it may be advantageous, and all this focus on the expenses of government, which we've seen a lot of attention on over the last few weeks. There's also, this is a revenue source for government as well. So in any case, I think the bigger picture that Brian, bottom lined a minute ago is that ultimately this has historically been considered bad policy because it slows the economy. It has an adverse impact generally, and we've been in this prolonged effort to create markets, to open up markets around the world so our goods can be sold there, their goods can be sold here. It creates some thought is it creates a greater interdependence and a lesser likelihood of adversarial risk of conflict around the world, and so that it is desirable to have more open markets. There is, I think, a focus on fairness in this administration that is all this being done in a way that is mutually beneficial. Probably worth more scrutiny than I'm able to provide right now.
So in a perfect world, there'd be no tariffs in or out, right? And for total free market.
I agree.
Right, but we don't have that here, and many other countries charge us to send our goods. They have tariffs on us, so
right.
I think that's what you're getting at.
Yeah, so I think that's part of the motivation as well, is to try to air quotes, level the playing field, so to speak. But in any case, I can't help but think of Ferris Bueller and the class, the lecture they have on economics there, talking about tariffs and the challenges that brought about when it came to the Great Depression. But in any case, tariffs are part of what's driving investor concerns when it comes to the stock market because of the unknowns as to how much this will have impact. And I start off asking Brian if he had any insights as to what kind of impact this might have. Are there any metrics you can share that might be useful for our audience, Brian?
Sure. So I think it's going to increase PCE by between 50 and 100 basis points, or 0.5% to 1%, if this persists, right? And that's the key word, if this persists. And if that's the case, I think it'll be very, very hard for the Federal Reserve to cut rates if we do have a growth scare, which we're having a growth scare. I mean, the Atlanta GDP now stat fell dramatically. It fell more than 6%, from 4% to negative 2.8% within a couple of weeks. So, that's that estimate is almost always wrong. But directionally, that's a scary move, right? So even if it's half right, we're in negative territory. So this is concerning between Doge and tariffs. I think that it seems like the relative confidence of the consumer is not good, right? The consumer sentiment surveys, which I put almost no stock into, are as ugly as they've been in 50 years. And the reason I put no stock into them normally is because they're very political. And the who answers surveys, it's usually one demographic. So you can discount that significantly, but when they're seeing numbers that are basically just falling off a cliff and terrible, it's something to note. It's at least a data point, even if you discount it. And the fact that it's political is it's a fact, but the people who you would think would be politically motivated to say sentiment's good seem to think that sentiment's bad. So it's kind of moving in the opposite direction of what you would typically assume through the political lens. So, there's not a lot of good data points going on right now. If I'm going to look for optimism, you have a lot of high quality stocks that are going on sale. And that's something that I'm enthusiastic about. You're seeing the 10-year Treasury rally significantly. So that's not only good for your fixed income, but if we have some stability at lower rates, it's going to be good for the real estate market. It's going to be good for stocks, all things equal. So those give you reason to be more confident. Now, given the interest rate situation and the kind of general sell-off, I usually call these liquidation events because they sell, indiscriminately. It's usually just seems like people are raising cash because they need it, or to pay debt service or whatever it is. I think that's a great opportunity to up the quality in your portfolio. I was just in a WEG macro meeting, and that was my recommendation to everybody. I said, this is an opportunity to clean out things that might be more speculative, might be more cyclical, and add to quality and secular strength names that you can be more confident that you're going to get at a nicer price today than you did a couple weeks ago.
Yeah, it's worth talking a little bit about how we've been positioning for some of these issues as well when it comes to some of our discretionary managed strategies within our team for our clientele. We can maybe talk a little bit about some of the ways that we've tried to be in a good position for volatility, which has now begun. Do you want to talk a little bit about that, Brian? Whether it's tips or whether it's the way you talked earlier about the utilities and low volatility positions in the mix of the portfolio on the stock side. Maybe talk about the fixed income side a little bit, and then our buffered strategy.
Yeah. So, we've been banging the drum that the S&P 500 is very concentrated for a while, for at least 9 months, and we've made an effort to diversify away. So, diversify, diversify, diversify has been, our mantra, and we don't have, excessive exposure, in my opinion, to any one single name when you, look through the portfolio to the underlying holdings, and that's very much on purpose. And I think it has insulated us from a lot of these sizable moves that we've seen from some of the biggest stocks in the market, over the last couple of weeks. So, I think that's number one. We mentioned the low vol strategy, we mentioned utilities, we mentioned, uh, um, we changed our value portfolio. We talked about our international allocation. Those were all ways of taking that high concentration from the growth names in the S&P 500 and spreading out the risk. And like I said, we've had some things do really well, particularly international and low vol and utilities. And that's again, mark one up for diversification. Now, we also thought that this could be a distinct possibility. In the last quarterly, we talked about how the Trump policies, although initially very much favored by the market after him being elected, mostly because I think the prospect of further tax cuts, them being maybe made permanent rather than the sunsetting provision. There was a lot of optimism. But we looked at the different policies and saw that almost all of them had an inflationary effect, or all of them did have an inflationary effect. And tariffs are, they're not only inflationary, but they're depressive as well. So, we added tips to the portfolio in the last quarter, and that's also been beneficial to the portfolio. We've probably stayed shorter in duration than the average person or the average
Tips
investor.
are inflation-protected treasuries, just for clarity, if people aren't familiar with the term.
We probably stayed shorter in duration than the average investor, and that's very much because we are going to be insulated if there's a rapid rise in interest rates in the longer term. But we very much have a barbell strategy right now. I mean, we have short term and we have intermediate term in equal weights, and that's worked out for us here. And we also have a strategic income fund that we want to take advantage of any short-term increases in spreads, which we've seen spreads be very, very tight for a long time. Spreads are the difference between what you get paid on a non-treasury bond and a treasury bond. And it's a good way of measuring the credit risk in the market, but also how much you're getting paid. And you haven't been getting paid very much. And I think the risk is only increases with time. So it's been an interesting market. We're not in any credit-oriented bonds to any significant degree right now. We have a very diversified equity portfolio, and we've been very short in duration and not taking a lot of interest rate risk, which has really insulated our portfolio, and why I believe that our strategies are doing fairly well here, at least in the black, despite a difficult S&P 500 performance.
So it seems that we've had some of these steps taken to try to be prepared. One, by this diversification both within stocks and within asset classes, and this barbell fixed income approach. For our most conservative investors, we've also opted to include a strategy that has a little bit of a risk buffer to it, on the downside, that can help be helping when these kind of events occur, to take some of the sting out of the movement of the portfolio. Brian, we've also talked. You mentioned one of the drivers for some of the concerns we had was not only this concentration, but we've talked about valuations a lot over the last several months, on the show and with our clients. You've said in the past that valuations aren't you can't really use them as a timing mechanism for when to make changes, but it can be insightful. How do you measure valuation? You don't really like the PE as the preferred way to do that, but this notion of trying to look at valuation, have we seen any material improvements with just modest volatility we've seen in the last few weeks? Has it you said some things are looking more attractive. Is it having an impact in some of the most expensive parts of the market?
Yeah, I mean, just I'll take Nvidia for example. It's in a 15% drawdown. I don't think the growth expectations are any worse really than they were prior to their last earnings call. So that stock, which is either the biggest or second biggest stock in the market on any given day, to me looks cheaper, just objectively cheaper. So yeah, I mean, I do think it's, when you have a sell-off, there's going to be opportunities. I do think it's important. You mentioned one of the reasons you mentioned I don't like the PE ratio, which I don't. That's accurate. So if the PE ratio, forward PE ratio, happens to go down on the S&P 500, I'd love to know, did they bring the E down too?
Yeah, that's something I was going to ask you next. What's the outlook for earnings? It seems like tariffs are likely to, if they stick around, it's not just a negotiating ploy of some kind. That would have some undermining impact on earnings. Is that, or at least price? It would have some inflationary effect on the cost, right? But it seems like it would have some consequence on earnings. Is that not?
Yeah, when you look at the entire market, I don't know how margins don't come in. Right. This is either going to get passed on to the consumer or it's going to get taken into margins. That's going to be worse with small cap than it is with large cap. But I think it's an inevitability, right? And I think right now we're just thinking about what sectors and what stocks are going to be impacted more. And I think, it's inevitable probably that margins will be cut. But if margins are cut and revenue goes up because they can charge through higher prices, the E might be fine. But and I think that's what we're all trying to suss out right now, right? And that's kind of why I said this is a complicated subject and we don't want to necessarily make a knee-jerk reaction.
That's a good point.
So I always preach I want to be proactive rather than reactive. And what does that mean? Well, I want to make a portfolio that can weather kind of surprise changes, and go up with the market when it's going up, and hopefully give a little bit of a buffer when it goes down. But if you are just reacting to the news headlines on a day-to-day basis, you're just going to get whipsawed. This isn't an easy science, and it's not even necessarily a science. I think there's some science and some art to it, and there's an overwhelming amount of data points and opinions that are being thrown at me right now. And what you need to do is take some time, maybe have some sleepless nights, which there's no shortage of for me, and think through what's important and what's not. And ultimately, you guys have heard me say a million times, earnings and interest rates are going to drive the total market, and consistency and growth is what I'm looking for in individual stocks. And that's nothing's changed in that calculus, right? So when it comes to the individual stock portfolio, I'm looking at my portfolio and I'm saying to myself, is this company not as consistent as I thought it was? Because if it's going to get, if the whole business model is going to get upended because of, an event like this, which we knew would be possible, then I made a mistake and I need to reevaluate, right? At the same time, is there a consistent company out there that's growing that's not in my portfolio, that I'm getting a nicer price on today than I was 2 weeks ago? And those are the questions I'm asking myself. Now, when it comes to earnings, when it comes to interest rates, they're decidedly lower right now, or at least the long-term rates. So that's in the plus column. When it comes to earnings, I think it's probably going to have to get ratcheted down, and it's a matter of degree. But when you have lower interest rates and lower earnings, they might be offsetting, and that's something that you need to consider. So, luckily I don't have to make any macro calls today. The quarter doesn't end for another 3 weeks, and I have time to take in the variety of opinions and look at what the consensus opinion is for earnings growth, and reassess my valuation model.
And we feel like we're positioned pretty well for what's going on,
Exactly. I mean, that goes back to being proactive versus reactive. I think if our clients were to look at their portfolios today, I think they'd be pleasantly surprised.
Yeah.
And that's I rather than be pleasantly surprised during a nervous moment than be elated when things are great.
Let me give Russ a chance to chime in here.
Yeah, thanks, Chris. Yeah, I did have a question for you, Brian. I guess going back to this topic of diversification and valuations, I watch Bloomberg in the morning when I'm eating breakfast, and I've had more and more of these international fund managers come on to talk about Europe and international markets more broadly.
I have no doubt they're running to the microphone these days.
Yeah, it's that way. So curious about your thoughts. You mentioned it earlier, but what are your thoughts on this kind of movement towards these international markets, towards Europe specifically? You said China as well. Is it just trying to get away from some of these U.S. names that might be quote unquote overvalued, or is there more substance to it? And is Europe finally coming out of the doldrums that they've been in for quite a long time?
As a general rule, we have an allocation towards international stocks. It's part of our diversification strategy. This isn't a tactical move that we have to have an allocation internationally. What we do have as our chosen allocation in our ETF mutual fund strategies is a fund that is fairly concentrated, and that's purposeful. We want to have a good allocation to the best names in the international market. And I think that we're achieving that. So the idea is if the all country world index ex-US is up 5, we want to be up a little bit more than that. And then that, if we're doing that, then we can be a little bit underweight international stocks, particularly since we don't like being in China, and still participate if the international market rallies. And I believe that we're over the last couple months we've seen that strategy has worked out for us. Of course, I wish I had a lot more of it when it does 7% and the S&P 500 is down. But nevertheless, I think we've achieved the diversification goal there. When it comes to China, we don't touch it or try not to as much as we can. And here's my basic reasoning. It's actually illegal for Americans to own Chinese stocks in China. When you buy a Chinese stock, you don't actually own the company. You own a legal structure in the Cayman Islands or somewhere else that sells you a certificate stating that you will get the economic benefit from the Chinese stock. So the Chinese could turn around and say, well, that workaround is no longer palatable to us, and then you don't have anything. And given the geopolitical tensions with the West, I don't know if that's a gamble I necessarily want to take. I don't know if that's a gamble I want to take ever, but especially considering that. Even if you do like it, the government there, they're historically a communist regime, and they'll change on a dime if they think they did this in 2018, but I believe it was 2018, and they believed that they thought the tech sector was doing too well, and they basically just killed it in a day. So you think of that. That's why we stay out of China. Now, generally speaking, international is going to be challenged, I think, because of demographics in the long term. If you think of Europe, they have a declining population. Japan, they have an aging population. China has an aging population. The only real growth you're seeing in population might be in South America and the EMEAs, Africa and the Middle East. So if you could find something in those areas that you want to hold for the long term, maybe that's something you're interested in. But I do think that's all those are good reasons to
where I
want to wait.
Yeah, I just want to chime in on this notion. I think, if we talk about the all country world index that you typically refer to, Brian, it's typically about 60-ish% US, 40% non-US. Correct? Roughly in that ballpark?
It's a little bit more US than that now, but yeah, in the ballpark.
And so I think when we think about our foreign exposure, that's our comparative, as to how much do we want to have. And we've been consistently in our own team here, we've been consistently underweight international relative to that benchmark with the equity exposure we have. That is probably the question, over time. Will we want to alter that weighting? I think a lot of that is relative. How do we envision economic and market movements relative to the U.S.? And that's how we would negotiate that, navigate that decision as to how much foreign exposure do we want to embed in our clients' portfolios. If we thought there was a prolonged opportunity for outperformance relative to the United States, I'm sure we would escalate our foreign exposure. The question is that our expectation today? And I think right now, Brian, correct me if I'm wrong, your expectation for outlook is not necessarily that Europe or other foreign markets are as likely to consistently outperform the United States as we'd expect today the U.S. to outperform or be a solid performer within that context.
Yeah, I think that's accurate. And, if you look at the equity, it's about 70% North America, which means, it's 30% of, other, about 5% China. It's recently been changed pretty significantly. So if you strip that out, we're looking at about 25% international. Our portfolios are about half that in international. And then, we have a beta of about 1.2. So, it's accelerated a little bit because of the beta. So we're underweight, but we're not crazy underweight. And I think hopefully we're getting the benefit. And in addition to that, up until very recently and still in one of our portfolios, we've had emerging market bonds, which has worked out really, really, really well for us. And so instead of having exposure to the stock market to some of these companies, we've had dollar denominated debt, which, as you can imagine, is going to be more consistent. It paid a nice yield for a while, and we did pretty well in that without taking, an abundant amount of risk while, getting some international exposure.
Jeff, let me give you a chance. Anything you want to chime in on?
I'm thinking about this in conversation relative to the recent market lack of correction, right? So we've talked about this another times when we've had Brian on about corrections. We didn't have a correction, a 10% drawdown on the S&P in 2024, I believe, and we're not there yet now. But I was wondering where Brian thought. We're talking about the geopolitical tariff impacts on the market and the volatility of it, but as we know, it's normal to have corrections in prices in healthy markets. So is this, do you think about this drawdown, these difficult days that we've had, that this could be just part of a normal market correction?
Well, corrections typically don't happen for no reason. I mean,
right.
It's usually some kind of news headline. So
yeah, that's my point. It's just it. It's just that correction.
I think if you're going to be a stock investor, this is the kind of volatility that you signed up for, right? That's why you get the long-term performance.
Right.
And, really I realize I do this professionally, so I've trained my brain different than the average, person. But I always say that the money is made when the market's going down, and it's just realized when the market goes up, right? This is when you need to do the job. If interest rates were steady and news headlines were benign and, the markets were ratcheting up, well, we pretty much just go to the beach, right? But this is what I studied for all those years. This is what I've been training for. And, I in some ways, I think since I've been working with Chris and the AMR team, back before we were the Wealth Enhancement Group, I've seen we had a bear market in 2018, we had a bear market in 2020, we had a bear market in 2022. This isn't anything that we haven't been through before as a group. And we've gotten through it and grown assets, and I think we've made some really, really good decisions during those times as well. And that's my focus. If we get, what are we going to do when we're given the fat pitch? Are we going to swing, or are we going to strike out? And I'm looking to swing. I'm looking for opportunities, and that's what you can do if you're being proactive and not reactive, right? If you aren't prepared, if you have an overly aggressive portfolio, if you're taking too much risk, well, then when something like this happens, you're almost in the position where you have to sell, right? And then you get these liquidity events. But if you've already built a responsible portfolio, and you're getting kind of, you're getting a negative reaction to the market, you could sit back and say, hey, look, I got some firepower, and I got the bat on my shoulder, and I'm looking for great opportunities. So that's what we're doing.
And that's probably a good place for us to pause the show. Thanks everyone for your participation. Brian, appreciate the perspective. Help people get a sense of how to make sense of what's going on in our, there's a lot of news, a lot of things to pay attention to. And we're trying to help people navigate that, and hopefully be anticipating some of the volatility that comes along, and how to be prepared, and then look for opportunities as they emerge. So thanks everyone for your participation. And I'll just mention as we close out, if anyone would like a little help along the way, if you're finding it difficult to navigate these markets and would benefit from a little bit of a second opinion, maybe get some insights, don't hesitate to reach out to us. We're here to help. What is the AMR-info at wealthenhancement.com. And we're happy to be a resource to you if you need any help. Until next time, everybody, keep striving for something more.
Thank you for listening to Something More with Chris Boyd. Call us for help, whether it's for financial planning or portfolio management, insurance concerns, or those quality of life issues that make the money matters matter. Whatever's on your mind, visit us at somethingmorewithchrisboyd.com or call us toll free at 866-771-8901. Or send us your questions to amr-info@wealthenhancement.com. You're listening to Something More with Chris Boyd Financial Talk Show. Wealth Enhancement Advisory Services and J. Christopher Boyd provide investment advice on an individual basis to clients only. Proper advice depends on a complete analysis of all facts and circumstances. The information given on this program is general financial comments and cannot be relied upon as pertaining to your specific situation. Wealth Enhancement Group cannot guarantee that using the information from this show will generate profits or ensure freedom from loss. Listeners should consult their own financial advisors or conduct their own due diligence before making any financial decisions.